Let me ask you something that most people never think about until it's too late. You've spent 30 or 40 years building your retirement savings. You've done everything right. You saved consistently. You invested wisely. And now you're finally approaching the finish line. But what if one single event could unravel all of it? Not a stock market crash, not a bad investment, just one health event. What would happen to your retirement savings if you or your spouse needed nursing home care starting tomorrow? If you do not have a plan for that, you don't have a complete retirement plan. And today, I'm going to show you exactly how to fix that. I'm Shonda Prescott, and this is Retirement Security Simplified, because your retirement is too important to leave to chance. Let's start with the reality that most people are not aware of, and that most financial conversations completely skip over. 70% of people who turn 65 today will need some form of long-term care at some point in their life. Let that number sink in. That is not a rare event that happens to other people. This is a mainstream retirement risk that affects the majority of retirees. And the cost? It's significant. Right now, the national average cost for a home health aide runs around $60,000 per year. An assisted living facility averages somewhere between $60,000 and $72,000 per year. And a nursing home for a semi-private room runs anywhere from $94,000 to over $108,000 per year. These are not small numbers. These are portfolio draining numbers. Now, here's the piece that catches most people off guard. Medicare does not cover this. I want to say that again because it's the most dangerous misconception in all of retirement planning. Medicare will cover skilled nursing care for a very limited window and only after a qualifying hospital stay of at least 3 days. After that window closes, you're on your own. And custodial care, meaning help with bathing, dressing, eating, getting around, that is not covered by Medicare at all. And that is what most people actually need, and Medicare does not pay for it. So, what happens when families don't plan for this? Let me give you a simple example. Imagine a couple. We'll call them Robert and Linda. They have $600,000 saved for retirement. They feel good about where they are. Then Robert develops dementia and needs memory care at $7,000 per month. In less than 4 years, $336,000 of their savings is gone. And Linda, who may live another 20 years, is now trying to make the rest of that portfolio last for the rest of her life at a fraction of what they had planned on. That's the real cost of not planning. Not just dollars lost, but the financial security of the spouse left behind. Now, let's talk about solutions, because there are 3 main ways to handle long-term care risk, and each one has its own trade-offs. Your goal today is to understand all 3 so you can have an informed conversation about which one fits your situation. Approach 1: self-insuring. The first option is self-insuring, and this simply means you plan to pay any long-term care costs out of your own savings and investments. For some people with very substantial assets, we're generally talking $2 million or more, this can be a reasonable strategy. If a care event happens, you have enough reserves to absorb it without catastrophic consequences to the surviving spouse. But here's the risk that most people do not consider. If a care event happens during a market downturn, you may be forced to sell investments at the worst possible time just to cover care costs. That's called sequence of returns risk. and it can permanently damage a portfolio in ways that are difficult to recover from. You lose the dollars and you lose the future growth those dollars would have generated. Self-insuring is an option, but it's only a safe option for people with significant assets and an open-eyed understanding of the risk they're accepting. Approach 2. Traditional long-term care insurance. The second option is traditional long-term care insurance. These are standalone policies designed specifically to cover the cost of care. You pay premiums, and if you ever need care, the policy pays a daily or monthly benefit to help cover those costs. In theory, this sounds like a straightforward solution, and for the right person, it still can be. But here's what has happened in the real world. Over the past 2 decades, many of the major carriers who sold these policies dramatically underestimated how long people would actually live and how long they would need care. As a result, premiums have increased substantially, sometimes by 40, 50, even 80%. Many carriers have exited this market entirely, and if you already have health issues, qualifying for a traditional policy can be difficult or even impossible. There's also the psychological barrier that many people feel about these policies. If you pay premiums for 20 years and never need care, you get nothing back. That use it or lose it structure makes a lot of people hesitant to commit. Traditional long-term care or LTC insurance is still worth exploring for the right candidate, but the landscape has changed significantly, and many people are finding other solutions fit better. Approach 3. Hybrid solutions using fixed indexed annuities with LTC riders. This is where I want to spend a little extra time because this is the option that most people have never heard of, and it's one of the most powerful planning tools available today. A fixed indexed annuity, or FIA, is a product that provides guaranteed lifetime income with growth potential linked to a market index, but with no direct market risk. Your principal is protected. Your income is guaranteed for life. But here is what takes it to the next level for long-term care planning. Many FIAs today include what's called a long-term care rider or a chronic illness rider. Here's how that works in plain English. You set up your FIA and begin receiving guaranteed lifetime income. If you ever reach a point where you cannot perform 2 or more of the 6 activities of daily living, things like bathing, dressing, eating, or getting around on your own, the rider kicks in and can even double or triple your monthly benefit to help cover care costs. That enhanced income stream continues for as long as you need care. And here is what makes this fundamentally different from traditional long-term care insurance. If you never need long-term care, you haven't lost anything. Your income continues as planned for the rest of your life. Your account value passes to your heirs. There is no use it or lose it structure. The product serves double duty: guaranteed lifetime income under normal circumstances and a dramatically amplified income stream if care is ever needed. Think of it this way: you're pre-positioning dollars inside a product that does 2 jobs at once, and you're doing it in a way that protects both you and the person you love most. Let's connect all this directly to your retirement income picture, because that is what is really at stake. First, the income floor stays intact. If a care event triggers the LTC rider on your annuity, the enhanced income benefit is designed to absorb a significant portion of those care costs. That means you're not forced to liquidate your investment accounts to pay the bills. Your portfolio stays invested. Your other income sources stay on track. The income floor you worked so hard to build does not collapse. Second, and this one is critically important, the surviving spouse is protected. When a long-term care event drains a retirement portfolio, it's usually the surviving spouse who pays the long-term price. Statistically, that surviving spouse is most often the wife, who may outlive her husband by 10, 15, or even 20 years. When the portfolio has been cut in half, or worse, by care costs, her income for the rest of her life is severely compromised. A properly structured LTC strategy addresses this directly. It protects her income, not just during the care event, but for every year that follows. Third, preserving your flexibility around Social Security and Medicare. When retirement savings are depleted by long-term care costs, it creates a cascade of unintended consequences. Retirees may be forced to take larger IRA withdrawals, which inflates their taxable income, which increases their Social Security taxes, and potentially triggers surcharges on their Medicare premiums. In a worst-case scenario, depleted assets can eventually lead to a Medicaid spend-down situation, meaning you have to spend nearly everything you have before the government steps in to help. Proper long-term care planning preserves your assets, which preserves your options for Social Security timing, for Roth conversion strategies, for Medicare premium management, and for everything else that depends on keeping your financial picture intact. If you are between the ages of 55 and 68, this conversation is for you, and now is the time to have it. Here's why timing matters so much. Long-term care planning is one of those areas where your options are directly tied to your current health. The more time passes, the more likely it is that a health issue arises that limits what you can qualify for or afford. Once that happens, the window on many of these strategies closes, sometimes permanently. You don't need to have everything figured out. You just need to have the planning conversation now while all your options are still on the table. Because once a health event occurs, the planning conversation becomes a crisis management conversation. And those two conversations look very different. Let me bring this home with two simple truths. Long-term care is not a fringe risk. It's a central retirement income threat that the majority of retirees will face. And the people who come through it financially intact are not the ones who are lucky. They are the ones who planned. The good news is that the tools to protect yourself exist right now. You don't have to choose between having income in retirement and being prepared for a care event. With the right structure, you can have both. If you would like to see how a long-term care strategy fits into your specific retirement income picture, please check out the link in the description box below and get the free booklet, Avoid Mistakes in Buying LTC Insurance. And if this video gave you something to think about, please give it a thumbs up and subscribe so you never miss an episode. I'm Shonda Prescott, and this is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.